Hello everyone, I am CS Ujjwal Pahava. Welcome to another episode on commodities. Today we'll discuss a very critical topic, leverage and margin. Let's discuss what they actually mean, how do they work, and what are the risks associated with them. So in simple terms, leverage means to use borrowed funds. Leverage essentially means using borrowed funds to increase the potential return of an investment. Leverage basically allows traders to control a larger position with a smaller amount of capital by using borrowed funds. I'll break it down for you with an example. Suppose I want to trade in futures on a precious commodity. The total value of the contract is rupees 10 lakhs, but the margin requirement is only 10%, which means I need to put up rupees 1 lakh. The remaining rupees 9 lakh is effectively borrowed from the broker. Using leverage, you can control a much larger position with a relatively small amount of capital. This can amplify your potential profits if the trade goes in your favor. What this means is, if the price of a commodity rises by 5%, the value of your contract increases to rupees 10 lakh 50,000. Your profit is 50,000 on an initial margin of rupees 1 lakh, a 50% return. So basically, leverage is essentially borrowing money to increase your trading power. However, it can also amplify your losses. If the price of a commodity drops by 5%, the value of contract falls to 9,50,000. My loss is now rupees 50,000, which is 50% of the initial margin. In extreme cases, losses can exceed your initial investment, leading to margin calls. So leverage can amplify both your profits and losses. If you heard me carefully, there I used a word in last sentence, margin. Let's understand what margin is. In a more simpler term, margin is the collateral required to maintain a leverage position. A margin call occurs when the value of your account falls below the broker's required minimum margin. When this happens, you will need to deposit additional funds to maintain your position, or your broker may liquidate your asset to cover the losses. This is a significant risk associated with leverage trading. In this example, if your losses widen to rupees 70 to 80,000, then you may have to keep more margin to secure your position in the trade. Otherwise, the broker will square off your position and you will have to accept the loss. So where commodities have a chance to make good returns with leverage, it can also lead to big losses. Hence, risk management is crucial. This includes setting stop loss orders to automatically close a position at a predetermined price, limiting the amount of leverage used, and ensuring you have sufficient capital to cover potential losses. Another way you can mitigate risk is through diversification. By spreading your investment across different commodities and asset classes, you can reduce the impact of adverse price movements in single market. And most importantly, like I've always mentioned, that staying informed about market trends and economic indicators is also essential. Factors like supply and demand, geopolitical events, and economic policies can all influence commodity prices. Being aware of these factors can help you make informed trading decisions. In summary, leverage and margin can be powerful tools in commodity trading, allowing you to amplify your potential returns. However, they also come with significant risks, including the possibility of substantial losses and margin calls. By understanding these concepts and implementing effective risk management strategies, you can navigate the world of leverage trading more safely. In the next video, we'll cover how external factors impact commodity prices in depth. So stay tuned for our next episode on commodities.
Investment in securities market are subject to market risks. Read all the related documents carefully before investing.